सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
In the last episode of Macro Sutra, we looked at the GDP numbers and what they said about growth rates and various sectoral growth rates. We're going to take a step forward on that in this episode, and we're going to use that data to also look at what's happening with savings and investments, and in particular, how households are changing their savings and investment behavior. I'm TCA Sharad Raghavan, economy editor at ThePrint, and we have with us Radhika Pandey, senior fellow at NIPFB. Thank you so much, Radhika, for joining us. So now, Radhika, let's start at the very basic, which is what is the savings rate and what are the kinds of savings that are included in this? I know that household savings is one big component, but what are the others as well?
Yes, so savings rate is when you express saving as a percentage of GDP.
Right.
So that is saving, that is as a measure of the size of the economy, what is the savings. So that is savings rate. And the National Account Statistics, the NSO comes up with this data on savings along with the GDP estimates. For example, on the 28th of February, when we got the GDP numbers and we got the first revised estimates for the last financial year, we also got the savings number for the last financial year, that is 2021-22. And we get savings as aggregate savings, and there are four broad components. Major component is the household sector, then is the private sector, public sector, and the general government sector. Now, what we also have is that within private and public sector, we are getting the breakup of savings by private financial sector and private non-financial sector.
I see.
Similarly, for public sector, we are getting the breakup of savings by public financial sector and public non-financial sector. And we get savings by general government, which is this saving, because general government is not saving much, they are spending. So there the saving number are typically in negative. Terms. So overall, the most important component of savings is driven by the household sector, and therefore it's very important to talk about household savings, where they are investing, where are they investing more in financial instruments, or are they investing more in, say, physical assets such as gold or real estate. Has the pattern changed pre-COVID to post-COVID? These are some of the interesting things that we get to know in this year's data, because now we have data for 2021-22, which is the first year after COVID. So we can actually see that once there was some sense of normalcy, how did the savings and investment behavior of households respond to that?
Right. So now just looking at the broad savings rate before going into the various elements of savings, the broad savings rate, how has that changed over the years, and what has the pandemic impact been on this?
So if we look at a slightly longer term horizon, if we step back a little and look at the early 2000s period, so we had very high savings rate during the period 2004 to 2010.
Those are the high growth years also.
Phase, normally the 2003 to 2008 period, the pre-global financial crisis period, we had high growth rate also. And a very important element of that high growth rate phase was high savings rate. So going by the new revised GDP numbers, 2011-12 base year, we see that the savings rate peaked at 36.9% in 2010-11. That is the highest savings rate that we have got since we have the data for the new base year, which is 2011-12. So there was an increase. So from 2004 onwards, we saw an increase, which coincided with the high growth phase of the economy. And it peaked at 2010-11. That was the highest level. And since then, we have been seeing moderation, gradual moderation in savings rate, which also coincides with a period of slowdown in the economy.
And high inflation.
And high inflation. So normally we understand the period starting 2011-12 as a period of slowdown, and there we also saw slowdown in the rate of savings. When we say rate,
Right.
we mean the saving as a percentage of GDP. We saw decline in savings rate, and it plummeted to a low of 28.8% in the COVID year.
Right. 2020-21.
2020-21, but in the last financial year, that is 21-22, the latest data shows that it has again stepped up a bit to 30%. So
Okay.
there has been an increase, and we hope that this increase in savings rate is sustained, but it's important to look at what is driving this savings rate.
Right.
But on an aggregate basis, if we talk about the 2004-10 period was the period of high savings rate. Then we saw a period of gradual moderation in savings rate, and then last year we have again seen a pickup in savings rate.
Right. And so now how much does inflation actually play a part in this? And also overall, is it a good thing that people are now saving more after the pandemic, or is it not? Because one could look at it from the point of view that more savings means that people are spending less, and so consumption expenditure is lower than it should be. But the other side is that people are earning enough to actually save,
Yes.
so which is a good thing. So
Right. So to answer this, let's look at the the three main components and what's happening to the household saving. Because as we mentioned earlier, 65% of the overall savings rate is accounted for by households. So when we talk about households saving, we saw a big jump in the COVID year. That was a part of it was forced also because there was lockdown. There was no avenue to spend, so they were saving.
Right.
There were savings also increased due to precautionary motive, where people saved for health emergencies and to also to guard against falling income, collapse in income due to low demand. So we saw a big jump in household savings as a percentage of gross national domestic income
Right.
in 2020-21. So
yeah.
so remember, the aggregate savings rate was declining, but household savings rate went up in the pandemic year. But now that in 2021-22, household savings rate has declined. Part of it is also because there's pent-up demand and people want to spend because in the COVID year they could not spend. Part of it is also because of rising income, and part of it is also because of inflation that they had to dip into their savings and spend more, because 2021 did see some elevated inflation levels also. So household saving behavior was such that in COVID year there was an increase. Normally what we see is household savings rate, when we express in terms of GDP, it hovers around 19 to 20%. So 30% is the aggregate savings rate, out of which household savings rate is around 19 to 20%. But this jumped up to 22% in the COVID year.
I see.
Because of the factor that we've discussed, lower avenues to spend,
and
higher
for precautions
and
healthcare
collapse
and
in incomes and so on. But now we are seeing, one is that there's some normalization because now there is pent up demand. But if we just look at the long term trend, what we see is that household savings have in fact declined, because
I see.
even after accounting for the fact that there is pent up demand and all of that, all those things, but still if we look at the long term trend, because what we have been seeing is that every year there is an increase of around rupees 2 lakh crore or 2 trillion increase in household saving, but this time around we saw a decline. So that is a thing that needs to be investigated further, that why even despite accounting for pent up demand, we see a appreciable decline in household savings rate.
I see. So basically what has happened post COVID in 21-22 is that the overall savings might have increased,
yes,
but the household savings has
declined. Yes.
So then what are the other areas of savings that have increased then, that is accounting for this difference?
There is one is the private corporate sector. As we mentioned that there is public and private, so there we see an increase. in absolute terms, savings has increased, household saving also, but as a percentage of when we
GDP.
talk in terms of GDP, there has been a decline, and that is again, if we delve deeper, it's mainly because of household financial saving.
Right.
So household savings are categorized into two parts. One is household financial savings, and the other is household savings in physical assets. So household savings in financial assets saw a big decline in the year after COVID.
I see. So again, now what would be driving this? Now people are putting more of their savings into physical assets as
Yes.
opposed to financial assets?
Yeah, so there are two broad components: household financial savings and household savings in physical assets.
Right.
When we talk about financial assets, we are talking in terms of bank deposits, mutual funds, insurance, pension and provident funds, small savings. These are some, and equity and mutual funds. So these are some of the broad avenues. And on the physical side, it is gold and real estate.
Real estate. Right.
Now, let's first talk about financial savings. In financial saving, as I said, there has been a decline. The overall household savings has declined because of decline in household financial savings.
Financial saving. Okay.
Whereas household physical saving has increased as a percentage of GDP. So now what is happening within financial savings? What is happening is that the share of bank deposit has drastically come down.
Right.
Okay, because of inflation, and we remember that 2020 and 21 was a period where the deposit rates were low.
Yes.
So bank deposit as a source of financial saving lost its attractiveness in 21-22.
Okay.
So if we look at a decade period, go back to 2011-12, almost 58% of the household financial savings used to be invested in the form of bank deposits.
Right.
Now it has fallen to 25%. So there is a big decline, and a major part of this decline, it has been happening. It has been declining because other instruments are catching up, which is a good thing. But from 2020 to 21-22, there is a big decline from 38 to 25%. That decline has happened in 21-22. So
this is the decline in bank deposits.
Bank deposits.
I see.
Yes. So now, where is the financial savings going if they have a decline in bank deposits?
Exactly.
They are going in mutual funds. They are going in equity. And we know that 2021 was a period of stock market boom.
Right.
There was a stock market rally. There was an IPO boom. There were the foreign institutional investors were net investing their money. There was excess of liquidity in the market. So, and bank deposits were offering very low return after adjusting for inflation. So we saw many people entering into the equity market either directly investing in shares or through the mutual funds route. So that is what has happened. The share of mutual funds has increased to more than 6% out of the total financial savings in 2021-22 from 2%. So there's a 4% jump in just 1 year from 2020-21 to 21-22. So that is one significant change that has happened in the composition of financial savings.
Right. So, I mean, just a small recap, financial savings as a whole have come down while savings in physical assets have gone up. Within financial savings, bank deposits have gone down, whereas mutual funds has gone up.
Yes.
And equity as well has gone up.
So equity, direct equity, as well as investments through mutual funds.
Right.
Again, we are investing in equity via pooled investment vehicles in the form of mutual funds. That has increased as a share of overall household financial savings in 2021-22. According to data from AMFI, so AMFI is Association of Mutual Funds,
Yes.
They say that they have onboarded almost 10 million people into the mutual funds in 2021-22.
Wow.
Okay, so things like systematic investment plans where they are investing every month, that has become a very popular means of savings in 21-22, and even this year. Even this year, we see that while FPI, the foreign portfolio investors, have been net sellers, but mutual funds have kept the market strong. They have supported the market, and if they would not have supported, markets would have tanked further. So we see a kind of maturity in investors, that they are diversifying their portfolio households. They are not only just investing in traditional saving instruments, which is the bank deposit, but they are also investing in other instruments, primarily mutual funds and equity directly. Another instrument that has gained prominence over the last few years is the pension and provident fund, which indicates that there is a move towards greater formalization of the economy.
Right.
Another positive thing. Now, in life insurance, which is again another prominent source of household financial saving, we saw a big jump in the COVID impacted year, because that time people, out of fear, they invested in life insurance policies.
Yes.
But that interest was not seen to have been sustained in 2021-22. So
Okay.
it has again come down. There was an increase in the share of the overall household financial savings going into insurance policies, but it has again come down. So the two things that have seen an increase is the pension and provident funds, and mutual funds and equity, amongst
right.
the household financial savings.
Right. And so now you've actually answered two questions that our audience had sent us. So one is that one of the big highlights pre and post pandemic was the performance of our stock exchanges. The stock market was doing very strong. So now what he asks is, what was the possible reason for the same? And do you think the bullish run will continue in the near future as well now?
Yeah, so as we discussed, there's some factors which contributed to the bull run. Was reorientation of foreign investors from China to India.
Right.
We saw a big IPO boom in 2021. More than 550 IPOs were floated in 2021. Then liquidity, foreign investment. So the stock market was going up, and that lured investors, first-time investors, to also seek an exposure in the equity market, both through mutual funds and through equity. So that is one very important feature that has happened, and it is seen to have been sustained this year as well, because this year as well, retail investors' participation through mutual fund has remained strong.
Right. And the other question is, one of the biggest lessons which the pandemic has taught us is that along with investments, you need to also have a comprehensive health insurance policy and life insurance. So do you think that although the impact of the pandemic has reduced, do you think that this trend will continue in the near future, and will more people invest in health insurance? But you're saying that it's already come down.
Partially, yes, we have answered this question, that it has come down in 2021-22. And also, if we look at, one very important indicator to assess the usability of insurance is the insurance penetration ratio,
Right.
which is the ratio of insurance premium to the gross domestic product, or GDP. And there we have seen that there has been a steady rise in the insurance penetration ratio in India. Economic survey also talked about that it has risen from 3.8 to 4.2% in 2021-22,
Right.
but it is still below the global average. The global average of insurance penetration ratio is 7%. In countries like US and UK, it is above 10%. So there is a scope for greater participation of households in insurance policies. What is seen is that they are taken just as a source of as a saving instrument rather than as a health protection instrument. So there are a lot of interest for money back policies and endowment policies rather than using them as a protection against health. So that is the kind of mindset that needs to change to see a sustained participation of households towards life insurance, and that is not happening. We see, if we look at a 10-year period, we see in some years the share of life insurance in the overall household financial saving has increased, again comes down, again goes up. So we have not seen a sustained rise. It was just that in COVID period there was a jump, which was understandable, but again, in the next year, that was not sustained.
Right. And now we have an interesting question, which is that there's a lot of anecdotal evidence that shows that some of the recovery in savings seems to be in the form of a K shape, where people are, there's a jump in sales of luxury cars, whereas demand for affordable homes is going down. So is there a way that we can tell this from the savings data that you cite, whether, which element, which strata of society is saving more? Is it that the rich are managing to save more? Is it that also the people at the lower end are being able to finally save some more?
Yeah, so see, there are two things here. One is the savings data, which comes from the national account statistics, the aggregate data, and then you have the breakup of that financial savings into bank deposits, insurance, mutual fund. That comes from RBI, which is
Right.
the flow of financial savings that is coming from RBI. Now, we don't get income-wise data on who is saving how much, but it's very, it is possible to link savings with what we are seeing. As you rightly mentioned, that there has been increase in the sales of high-end cars, there's increase in the sales of luxury houses. That is
Right.
happening, and one of the main reason for this is that one is pent-up demand, the other is increase in income, and we are seeing increase in the demand for mid-range and high-range houses. Amongst the luxury houses, there's a lot of good data put out by these real estate companies, which shows that inventory overhang has gone down. Inventory overhang has gone down means that there has been a pickup in both new launches of houses and the sales. It's not that houses are being launched, projects are being launched and they are not being sold. So we are seeing, particularly post-COVID in 2021 and 2022, that launches are being supported by sales also.
Right.
And that sale is happening not just in very high ultra rich, which is happening definitely, but it is also happening in the middle range. And one of the main reason is that real estate investment is gaining popularity as a hedge against inflation.
Right.
Okay, because the deposits depend on inflation. If you have very high inflation, deposit rate is fixed, you might get negative returns. We were getting negative returns. If deposit rate is 5%, inflation is 7%, it's a negative return. Same is the case with gold. Though even in gold we have seen increase in savings in 2021, but the increase in real estate has been much more than that.
Much more, right.
If we just talk in terms of numbers, there has been a jump of rupees 4 lakh crore in 1 year in real
Wow.
estate. So the data is the gross fixed capital formation in the household, and we see that real estate and dwelling, that has seen a big jump, almost more than 4 lakh crore from 2020-21 to 2021-22.
Okay.
So it's driven by multiple factors. One is pent-up demand, one is improved income, one is that people are coming back from abroad and they need houses to stay here. They have lost income, they have lost their jobs abroad, they are coming back, so they
Right.
need houses. So, and also that it's a best bet against the rising inflation at this point in time. So these are some factors that have increase the demand for houses. Now, in this year's budget, we saw that PM Awas Yojana's allocation has been increased.
Was
We
increased.
talked about.
Right.
So this would give a fillip to even demand for affordable houses as well. Even the government's infra push is going to lead to greater demand for real estate. So real estate demand is likely to stay elevated, not only in 2021-22, but also in 2022-23.
All right. And so now we've received quite a few questions where you all are asking us for investment advice. I can tell you that we at ThePrint are not going to tell you where to put your money. All we can do is to provide you the underlying facts, and where you put your money is up to you. But there is one thing that we can talk about, which is that now since May 2022, the RBI has been increasing the repo rate a lot. So it's been 250 basis points since then.
Right.
And that's now finally also been transmitted to the deposit rates.
Yes.
So your fixed deposits and recurring deposits have all become much more attractive.
Yes.
So possibly we can see in the future that money will start shifting back to these instruments?
Absolutely. In 2022-23, we should see an increase in the share of deposits because in 21 there was a big jump in inflation and there was no increase in interest rate at all. So we saw negative, inflation adjusted returns on deposits were negative. We should see a reallocation, but What is sure is that in mutual funds, in equity, the share is likely to remain elevated, because
Right.
now that people have invested, they are likely to stay there. And we have seen that in terms of mutual funds buying activity. They have remained net buyers all throughout mostly all months of this financial year 2022-23, despite FPIs turning net sellers. So mutual fund equity is going to take a greater share of household financial saving,
Okay.
but deposits will also retain some part. So there is going to be some churning and reallocation in 2022-23 as well. And amongst the physical savings, real estate
Will continue.
will continue.
Right.
Yes, as of now, it will continue.
Right. So there you have it. Post-pandemic, the overall savings rate has increased, but the household savings rate has come down a little bit because inflation started hurting. Within that, financial savings
Yes.
have come down, and the shift has been towards things like real estate and gold. In the near future, real estate is set to still be a place of high demand. People are going to continue investing there. Bank deposits are likely to see more investment because finally the deposit rates are catching up to the increases in the repo rate. Mutual funds and other market-linked investment destinations will also continue being popular. That's all we have for you this time. Thank you so much for watching.